Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. VG Kannan, former chief executive at IBA, joining in. Welcome to the show, Mr. Kannan, and always a pleasure to speak to you and get insights from you. To start off with, overall, with regards to the banking sector as a whole, Mr. Kannan, a lot of measures that the RBI took in the initial stages of COVID, and that's something which actually came to our rescue. Now, if you go to see, all eyes are on how the credit growth pans out. We are hovering in that 6 to 7% range. What's your view from here on?
As you rightly mentioned, I think the credit growth has been muted. Credit growth has been happening mostly in the retail sector. And in fact, if you talk to any banker or anyone in the market, they think they're growing very healthily in the retail sector. But you need to understand that the retail sector, especially the individuals, are dependent on either salary income and or the entrepreneurship income. That means there has to be some industry and company which is there to employ them. While the existing people, there's a lot of switch in jobs, etc., and people are getting good jobs. But there is still a lack of new industries coming up, and that is the cause for concern. If you remember, before 2014-15, the growth used to be around in the range of 9 to 11%, 12%, whereas the entire thing has been muted right now. I can't really blame on the pandemic alone, but we have not seen any new industry coming up. Once the new industries start coming up, I think the credit growth also should be quite healthy and much better. And the focus of the banks, which has been substantially towards retail, will also get distributed to something towards the industries. Having said this, I think there has been a sort of a caution by the bankers, both public sector and private sector, toward the industries. And from the industry side also, there's been a lot of deleveraging. So a combined factors of all these factors together ensure that the credit growth is there positive, but more in the retail sector.
Right. So overall, Mr. Kannan, right now the expectation is that the credit growth that will come in is going to come in from the PSU companies because they are the ones who are actually doing the capital expenditure. However, what's the view that you have, especially on the private sector front? Because the capex that is required to drive credit growth from the private sector front as well, that's yet not started to happen.
See, what happened, there's been a lot of caution, both from the bankers, lender side, as also the borrower side. And most of the corporates have now started deleveraging. But I think the deleveraging cannot go on forever. And they need to start expanding. And especially when you look at certain sectors like the road sector, the cement sector, the industries, all of them will, once the normalcy comes into being, I think they will all have to expand. And once the expansion takes place, then they cannot obviously get everything from equity capital. Therefore, they need to raise it, and raising equity capital is much more expensive because the cost of capital, equity capital could be as high as 25-30%. Whereas a debt capital could come sub 10%. So that being the case, there will be a demand. I'm not actually seeing any green shoots in the horizon about new industries coming up. It will all depend on, maybe, as you rightly mentioned, if the PSU start the ball rolling and they do it, and then they find that, yes, truly there is a pickup in the demand, etc., then the private sector also will join, and then you'll have a much healthy growth. PSUs have been borrowing even in the recent past, but that cannot really be called as a huge credit demand. But I think the private sector have to create the demand. The very fact that the government is also going for privatization also means that the quality of the credit and the efficiency of the use of credit could also be make a difference once it goes into the private sector. So I think we need to wait for it. But today I don't see anything starting in the next 24 months.
Right. And overall, with all of this, what's the view that you have, especially with regards to the restructured book is concerned right now? And, especially if you have to take into consideration the asset quality first, uh, we don't really see any risks on the horizon on the asset quality front. What is your take, number one, on it?
Here, we need to the asset quality in three different areas, or let's say four areas. First question is the large corporates. And
Hmm.
large corporates, by and large, I think we don't see any fresh stress. There could be some occasional cases, but by and large, I think everything has been handled in 2015, 16, and 17, and they are all either under resolution or under liquidation, both ways, and all the banks have provided. Therefore, there won't be any new provisions for that. And as per the RBI guidelines, restructuring for this large corporates beyond a particular scenario, except under the provisions of the COVID, would be treated as an NPA. But we don't see too much of a stress in the large corporate. In the small sector, I think they badly needed it, and they were the ones who got affected most. You look at the hospitality sector, those sectors which are dependent on education, construction, and I'm not looking at the 10 crores and 25 crores. I'm looking at the smaller ones. They have been most affected, and wherever they've been affected, and people do not have alternate means of raising funds, or alternate means of revenues, they've all gone for restructuring. I expect about 90% to 95% of those stress assets to actually come out or repay their assets on time, provided, of course, I need to put a word of caution that there's no third wave or any requirement of any further closure. So that is we were all quite confident that sometime in November, December, and the Prime Minister also mentioned that we have conquered it. But you know what happened in March, April, and then the second wave struck, and then it became much more severe than the first wave. So if we set aside those things, I think they will do well. The schools and colleges are reopening, which is also a healthy sign that the transport sector would also do. Uh, uh, in fact, I was just mentioning the other day, the best thing to notice whether the economy is picked up is to see the chai wala, the dukan. If there are people milling around the chai wala dukan, it basically means people are started going out,
Hmm.
and people started going to their offices, and they step out there of their offices for a cup of cutting chai and snacks, which you're seeing a lot. But the in dining restaurants and all is still not fully picked up. It's still empty. I think maybe people have to come out of the slumber of having been at home for the last almost 2 years now, and that will take some time to pick up. But the hotels are also working. They're also working at 30, 40%, 50% capacity. But certain industries, especially where they were having a boom time just before the COVID, they may still continue. But it'll be a long drawn process. Theatre industry that has been affected, and
Hmm.
wherever the government has interfered, saying that we should not have crowds, and crowds have been there. Malls are there open, but you find more of a window shopping rather than actually footfalls to pick up. There are cases that picking up, people are picking up, but yes, slowly and steadily, everyone is walking into this shops and all. Diwali could be a early indicator how things are pan out. If we don't have any further cases going up, I think the worst will be our away, and then the worst is out of the way, and then we should be doing very well.
Right. So, Mr. Kannan, overall, from what you're saying, again, a lot of people are projecting the NPAs of banks to say increase to 8 to 9% in this financial year, though it will be below the peak of that 11.2% that we saw in the year FY18. Now, we're talking about the COVID relief measures that were given out in terms of restructuring, or you talk about the emergency credit line guarantee scheme. Do you think all of this could help restrict growth from here on?
See, see the restructuring and the emergency land credit has all been given to the existing companies which were suffering. And believe me, I think when you talk to many of the bankers, they said not a large number of people have taken. There's a good number. I'm not saying it's not there at all, but many people have somehow felt that they do not want to have the tag of restructuring.
mm,
They have somehow managed to keep afloat, and they are in a position to either raise funds from their own areas and other sources and
mm,
repay the new credit growth is not taking place, and that, as you said, hardly 5-6%. So that will be the pace at which it will happen till the large corporates come. And I don't see that 89% could be selective in a few banks and few areas, but not widespread. It will be much more than what it was there before the COVID, because in the COVID effectively shut down many of the shops. And after the first wave, we found a lot of people who were dependent on migrants. They were
mm,
also affected, and you don't the migrants may not be very highly skilled, but at least they got used to a certain quality of and quantity of work, and getting a new person to start afresh will be a problem. And many of them have come back also. I do see around that many of the people have come back. If that the NPS will not go up. But having said this, I don't know what's the quality of the restructuring, because uh, if you're expecting that everything is going to be hunky dory pre-COVID from starting now, it's going to be a very
mm.
long haul, because as I told you, restaurants and eateries, they are hardly up to 30-40%. And that has been a good source for employment, as also a lot of debt also. Around you and around us, I think you must have seen many of
Mm,
the
mm,
shops changing hands, which is an indication that someone either have thrown in the towel, or some people have felt, okay, enough is enough, and someone else has come in place with the same activity. But hopefully, thinking that the entire thing is off. In fact, I saw some new shops coming up post the first wave, but closed down post the second wave. So it's a very difficult situation, but things should be improving going forward.
Right. So, Mr. Kannan, overall, if you talk about restructuring as well, the anticipation is it's mainly the MSME and the retail segment that is likely to see a higher accretion of NPAs and stressed assets. And again, a 4 to 5% of the loan book that would lead to growth in stressed assets from this book is what everyone is anticipating. So, overall, I mean, how much of the restructured books can then slip into NPAs? What do you think should be taken into consideration?
Yeah, normally the past, whenever the teaching was done, it was done relatively more perfunctorily. I know you had almost 30-40% or 50% to becoming MPA
Mm,
in 6 months to 1 year. But this time around, hopefully, of course, there have been some conditions of which you cannot be restricted beyond a particular period and all. But if all of them have been liberally given, I think I won't expect more than 5 to 10% of the restriction book to slip in. It could be slightly higher, but I think it all depends on when you open up the economy completely. The more and more you open up, and more things people feel comfortable. And just through your channel, I would again like to say that people should get themselves vaccinated, and that will give you some physical and psychological comfort for you to face any scenarios. And the very fact that more than half have been vaccinated, that has given some confidence to people to move around also. So I think all said and done, I don't expect more than 10%, maybe a couple
mm,
of
mm.
section book to fall. There could be some initial slippages where things have not started, but in case the activity has started, I think it will not be much. And the figures which is coming out so far from some of the banks doesn't speak of any very large increase in NPS. We'll have to see how the public sector banks also do it.
Right. And what's the ground level report you have that tells you about the pain in the mortgage segment? What's your view on that?
On the mortgage segment, you have
Yeah,
housing loans, you're saying.
correct.
In fact, you see a lot of activity now. In fact, I was just talking to one of the investors, and he says, I expect that the NBFC and the housing finance to go a big way. because I think the prices of the flats and all are all stabilized, and now with the kind of RERA kind of focus, the compliance to RERA, etc., will ensure that the builders also are in a position to complete the projects on time. I think there's more confidence in projects coming. But having said that, I think the builders also need have deeper pockets. The experiences of many of the buyers in the past, where they found that projects have not been completed for years together or even decades, would mean that people are looking for projects which are either completed or near completion. Therefore, that is one issue. So, but if you complete it, I think you will have your higher margins. But then it means that you have to, the builders have to shell out more. So that is which we'll see. And once the reputation of the builders come up, I think people will start going back to booking at the stage of booking stage itself rather than at a later stage.
Mm, mm. Right. And very lastly, Mr. Kannan, what would your view be on the interest rate cycle? Because the RBI has continued to remain accommodative so far.
Right.
Secondly, in terms of where liquidity goes, we don't think so there'll be any additional liquidity infused into the system, taking into consideration the quantum that is already existing. So by when do you see the interest rate cycles turning for us?
I think we have probably seen for now the bottom of the interest rate cycle. I won't say that it's going to sharply rise, but if you talk to the bond markets, that the bond dealer would say, "Oh, it has risen very sharply from 610 to 615 or 625." So because that portfolio gets negatively marked to market. But I think with the abundance of liquidity in the system, I think the interest rates will remain flattish. Uh, I do expect that maybe that could be a one call for a interest rate hike in this financial year, but certainly something in the next financial year. All depends on so many factors:
Mm,
uh, government spending, the government deficit, how they are in a position to raise the taxes, as also here. Unfortunately for us, the oil prices have also been going through, and you and
correct.
I had uh, uh, buying diesel and petrol above 100 for the first time in our life. So that is going to further affect the profitability of all the ventures who are dependent on transportation. So you have a cycle where the funds are available, but then your cost of manufacturing, other than interest, is going to go up by the means of the oil prices. Even the wages are going to go up because overall the inflation, the retail inflation is going up. The wholesale, the mortgage sector, it's just inching up. It's not really going up. So
Mm,
I think it's more or less at pre-demonetization levels or
mm,
even
mm,
before that. So that is not really hurting them. But going forward, that might. So I have a feeling that the interest rate will remain benign. I won't say it will go down, but it will not go below 6.25, etc. But it will not go above 6.75. So I would put a range of 6.25 to 6.75, the 10 years. And it does affect what do you call people like me who are retired, who have to depend on interest saving. But well, if the overall cost is coming down, that's well and well,
mm,
but that doesn't seem to be the case. So that could be a scenario where RBI would be forced to hike the interest rates marginally.
mm,
Uh,
mm.
and as you mentioned, they have already started becoming less accommodative than what they were before, with a little bit of withdrawal of the accommodation stance. Overall, they will continue to see accommodative stance till the actual good credit growth pickup happens,
Mm.
or a very sharp increase in inflation.
Absolutely. Well made point as well, Mr. Kannan. Thank you so much for joining us on the show. Always a pleasure to speak to you, get insights from you. Thank you. I hope you enjoyed the conversation as well. Stay safe and speak to you soon again.
Thank you, Hiral, and
Thank
have
you.
a wonderful.
Thank
Thank you. Bye. Thank you. Bye.